Hello everyone and welcome back to lesson 8 of the cryptocurrency course. Now in this lesson we'll be going over one of my favorite topics and one of my favorite strategies to actually use within the market, which is trendline retests and breakouts. Now one of the most important things to note when it comes to understanding trend lines in cryptocurrencies is it's literally on a give or take basis. Every single trend line can differ depending on the market conditions, depending on the current price action, depending on just overall in general what the price is doing at that point in time. Sometimes, as you guys have seen from the Fibonacci lesson, we can sometimes plot Fibonacci's from, for example, wick to wick, body to wick, body to body, vice versa. There are so many different ways to do this, but when it comes to trendline application, as you may have already seen from prior lessons, it's important to not fall into the bracket of the cliche traditional methods that everybody seems to do when it comes to trading trend lines and breakouts, as an example. Now, when it comes to trading trend lines and breakouts and retests and all of that stuff on BTC as a specific example, you can still use this on many other pairs as well on an experimental basis. However, it does tend to work a little bit better on BTC in comparison to some of the other altcoins. Now, when it comes to a daily perspective, if we go to the monthly time frame, obviously when we are going parabolic, it's not going to work as well, because on a consistent basis, as an example, sometimes price will never properly retest. Now, although that does technically count, normally, when it comes to the strategy, which you'll see in a minute, we like to see some form of significant move higher first, then coming down to retest the trend line before continuing higher. However, in a market like this, where it's just going absolutely parabolic to the moon, it can be a little bit harder to interpret. Now, from a daily perspective, if we were to plot that trend line, you can see once you go down to the 4 hour or so, it does become a little bit clearer and it does actually become a rather valid setup. However, when using the daily time frame as an example over here, it can be a little bit harder to interpret because the price action is seemingly relatively small. It can put you off actually entering a potential trade setup that is presented to you on the charts. So what we want to be doing here, although we can see a good example there, is going down to the 4 hour and predominantly the 1 hour and the 30-minute time frame, which is where I tend to find the best opportunities to take a trade. So from a 4 hour perspective, especially in a market that's moving like this, one of the best things you can do is actually get retest and short positions versus taking long positions, depending on what time frame you're using. So one of the key things I like to do is looking for trendline retests, as in a support trend line, for then some form of breakout retest and continuation to the downside. Now, if we first go from over here, we can see we've broken through the trend line after rejecting several times. We've broken through, we've retested, and then we've absolutely dumped. So if we went over to the 1 hour time frame now, to put this into a bit more perspective, and also just note you could even push it a little bit higher, but it wouldn't have been valid in this particular circumstance, which we will be getting to shortly as well. We can see over here, upon breaking out of the trend line, we broke through, retested. This is often a trap and one of the least likely opportunities to actually come through. When you see a sharp break for a trend line and then price retest instantly and dump, whilst it can provide good trading opportunities, the truth is the majority of us are not likely to hold this any further and actually take the profit down here, because we're probably expecting much bigger moves. So it's very easy to say in retrospect, as an example, if we were to enter short upon the breakout of this trend line and retest here with a very tight stop loss, let's just say just above the candle bodies over here, when price does drop, although it would have provided over 2.5% profit, it's very unlikely we would actually be taking profit during these kind of movements, because you'd be waiting for more of a movement like this. Now, what I tend to do in these situations is when you do see the breakout, try to avoid the impulse decision to enter immediately upon the first retest, depending on how sharp the breakout is. Now, if you were to enter upon the very small retest over here, whilst you may catch a very short-term move, you are opening yourself up to the potential risk of price driving back one more time for a much larger retest before continuing in your favor. So in this particular instance here, you would have achieved over 2.5% profit only to inevitably end up in a potential loss, especially if it retested here and then reversed back again. Now, again, it's a case-by-case basis, and not every single time is it going to be absolutely perfect. But what you can do, depending on the time frame you are using, if you are using a major trend line, like one like this, for example, then you would have to be sticking to more of a 4-hour time frame. The truth is, if you go to the 30-minute over here, and go all the way back over to this particular time frame where the entry would have been, even if you waited for the second retest over here with a relatively tight stop loss, let's just say you were looking to capture a massive move all the way down to here. Unfortunately, you would have likely been just fallen short of stop loss being hit here, but then stopped out on the second move. And that is because the trend line is so large and it's focusing on a major time scale. Therefore, for catching shorter term moves, the best thing to be doing is looking for trend lines on that specific time frame, which will actually likely give you much better trading opportunities. Now, if you went over to the 4-hour time frame and you were looking for a very similar movement in that manner, remember you can also slightly push that higher. Normally, the general rule of thumb for myself when it comes to trend lines is adapting. Now, the very first thing to understand with trend lines is whilst many people would often go for the furthest wick to the extension, this can often be a case-by-case basis until price has actually confirmed what it will be doing next. Now, the general rule of thumb when it comes to trading trend lines is the third trend line bounce is usually a manipulative move. So at this point in time, let's just say this didn't happen yet and we were only at this current point in time, which I can actually do by putting the replay tool over here. We can see upon this potential rejection here, we can draw a trend line over here from the first wick, not from the extended wick, the very first wick that forms a reversal. Now, once we press play and price begins to move, before this even happens, we would have had this plotted here. Now, because we've gone from the wick to the very first wick, not the extended wick, although it can often come through, we still saw a false breakout. If you go to the very first wick over here, you tend to actually be able to capture much more of the manipulative moves, especially when identifying potential third false moves and retests of the trend line. Now, many people have asked me, why is the third move often manipulative? And that's because once a trend line has been formed, remember, you do not necessarily know a trend line is valid until you've seen a valid reversal from the second swing high or swing low, vice versa. So because we saw a solid reversal from this region, we can see that this is now becoming a valid trend line. So what that means for us is when we wait for the next potential retest, the third move is likely going to be false. So if we were to go over to the 1 hour perspective over here, we can see regardless, wick, wick, wick. You can even just refine that slightly on the 1 hour to see all of the wicks coming through. This doesn't count as a third retest. This is still within the second retest region because it's so consistent. Only once you see the huge upside movement or the huge downside movement, and then we come in for the second or third retest, do we then decipher if this is a false move. So because we've had the solid trend line, we've had a reversal from this region, price came back in, we get a false break of this region, we can then look to take a trade over here with a stop loss just below the prior low from the second retest of the trend line, and then ride this the whole way up, which if we just monitor for a second, would have netted us a fairly decent profit. And if we even took profit over here, that would have been pretty much a 4% trade. So that is one way to look at trendline retest in terms of actually just following an average trend line. However, that can be relatively risky. And one of my personal favorite methods when it comes to these strategies is not catching the third trend line false move, not catching the breakout, but catching the retest, which is where a bit of top-down analysis does come into play. So just so you understood the overall basis of trendline applications, now we need to focus more importantly on the strategy itself. Now, the first part of all of this is, of course, understanding what the higher time frames are doing, as we do not want to go blindly into a particular position. Even if it is an intraday timescale, we do not want to be putting ourselves at additional risk by going too much against the trend, unless the price action, of course, is insinuating it may potentially continue in the favor or direction you are looking to trade. Now, if we go over to the 30-minute time frame, this is where things can get a bit better. As a good example, let's try and find one little example over here that may have come through. where we can get a nice trendline retest. Now looking at this may have potentially been a trendline retest. Nope, that one just fell short. However, if you put it down to the body, then you move it over to the wick, we can actually see, which is probably the perfect first example of a case-by-case basis, sometimes, and something I do often do, understanding that the overall momentum is potentially going to be to the upside, looking at trendline retests like this from body of the all-time high. Again, you don't want to be using this wick, because if you use this body or wick over here, you're of course cutting through the price action. So you normally want to do, when looking for a bearish trend line, aka a resistance trend line, you want to be placing the wick on top of the bearish candle from the body if you are using the body to wick or body to body method. Even if you went down from body to body, technically, if you go to the 15-minute, I have no doubt there probably would have been a potential retest there as well, but it does become a lot riskier when trying to do something like this. But even when going to the 15-minute as an example, from even the wick to wick over here, pushing this down a little bit lower, again, not the second one, the actual first real wick that pushes up, you are able to then see that when this comes through, what many people first do is people buy the breakout. When the trend line breaks, again, this could be considered the third fake breakout of the trend line as well. So many people would be entering upon a breakout of a trend line, not realizing it may even be, whether it's a higher time frame, whether it's a lower time frame, the third touch is often false to continue the move down to the trend line before continuing in the opposing direction. So very frequently, the third breakout is a sign that price may be continuing higher, but it will very likely come much lower first to retest the trend line, as it's done twice again, and then the third time, and then it continues higher. And you will often notice that when this does come through, it can sometimes take out the low over here, but price fails to break below that wick. You have a very strong buy signal over here upon another retest. So whilst the majority of people would be looking to potentially even go like this and then look for a buy position, it really isn't worth going into a significant amount of drawdown only to then hopefully see it just about reverse and go in your favor. And realistically, most people would have a stop loss more like this, which would have just been triggered out instantly. So if we went back to the 30-minute time frame, you can see from the false breakout here, that again technically would have been a potential short. From the breakout over here on the third retest, you could place a stop loss just above the wick here. You could easily get yourself around 1.5% or so, but again, incredibly risky, and that's not what we're looking to do on these particular setups. But what you can do, and one of my more favorite strategies, is waiting for, again, this was a head and shoulders as well. You've got the shoulder, the head, and the shoulder spiking through. So you've got multiple formations forming on this particular time frame that can work out quite nicely. So as we can see here, we've got the breakout, we've got retest, retest, false reversal again, which we can also use a potential Fibonacci in our favor. Now, as we can see, by doing this, we'll get rid of the 0.5% and stick to the 61.8. We can see, using the Fibonacci skills and the education from the prior lesson, alongside with everything else that's been shown to you guys so far, what you can see here is the A, the B, the C at the 78.6, price coming all the way back down to fulfill the Fibonacci target, spiking through, hitting the trend line, which is where we then have our buy signal, which provides a much larger and higher probability to take a profitable trade that will very likely not go into drawdown. Now, let's just say the moment it touched this trend line, you entered. Relatively tight stop loss, could have even been tighter because of where price action was, and then you just let this ride. As you can see, in terms of catching these movements, if you were to really and truly in line with higher time frame analysis, you can potentially catch some Goliath trades all the way up to 15% plus, as you can see here. Now, realistically, again, in retrospect, it's very easy to say we would have done this and we could have done that, especially in this particular instance where if you just held in line with a parabolic market, you probably could have made around 26%. But again, these are opportunities which we likely would not be holding the whole way for unless we really saw instantaneous upside movement where we could then go onto the 4 hour, for example, and go, okay, 1 minute, this is actually now ripped through the highs, it's retesting, now we can see a continuation higher. And if you plot another trend line here, even to the body over here or over there to be a bit more precise, ideally I would have gone for the body, maybe have got caught out on that wick. But if we went from here as an example, just to show you again, the trend line breaks, this would have been a nice confirmation to either add another position or just hold the trade altogether. But let's just forget this for a second now that we're back on the 4 hour. In this particular instance, as another good example, if you were to enter the breakout of this candle, let's just say over here, which is traditionally what they teach you in traditional methods. If you go on Baby Pips or any other kind of educational platform, they will teach you to enter upon a breakout, put a stop loss just below the trend line. It will then come in, likely wick you out, and then continue in the overall direction. However, if you simply just waited for a retest over here with the exact same stop loss just below that low over there, you very easily could have achieved almost 3% on that particular trade as well. So hopefully it's a bit of an eye-opener just to first of all eradicate a lot of the traditional methods we've been taught from, whether that's from courses, educational platforms, or just in general from hunting online on forums and stuff. A lot of the stuff we are taught is generally a trap for the retail trader. Now, when they say the majority of retail traders lose, it's because they are all being taught the same traditional methods, and market makers understand this. So market makers are purposely setting up ploys and traps in the market for us to enter, for them to then go forward and potentially liquidate our positions from there onwards. So one thing to keep in mind at all times is the majority of price action we see, and even the market overall, is set out to get us. The market is not our friend. The market is not there to help us. The market is essentially there to make us lose. And our goal is to identify these traps and avoid losing any money when the market does present those potential trade setups. Now, let's go to find some more opportunities. Now, if we go over to the 30-minute again, can be relatively difficult in market conditions like this. However, I think I've just found another nice little setup over here. And yes, I have. Now, if we went over here, plot that from there. Again, the body would have been more relative, but that would have been a bit of a hard one to catch, but it would have been a fairly good trade. Not every single one would be positive. However, let's just use this as an example. So we've got 1 second wick. Remember, if you go over from this particular wick, you likely would have entered here and then got wiped out, because that would have looked absolutely perfect. So this is another good example of why we like to try and use either the bodies to form the trend lines on crypto, unless it's higher time frames, or try and stick to the very first wick that forms the majority of that second retest. So if we went from wick to wick in this particular instance, it would have looked like an absolutely textbook setup. Wick, wick, retest, break through. Again, it could have even been a trick for a potential third false move to then buy. We would have been wiped out that side as well. But if you were patient and then we saw a drive lower only to come back higher, even myself, if I was to see this using this method, I probably would have entered here with a stop loss just above these wicks over here, looking to potentially catch another move down to this low or down to this low. However, because the trend line was incorrectly drawn, we would have been absolutely annihilated almost instantly with this movement going the whole way up. So what we want to be doing here is, first of all, adjusting as well. Remember, being dynamic is absolutely key when it comes to the market, and especially in cryptocurrencies, you often see, especially the members of Innovation Markets, you guys will know when we are doing the live analysis, especially the scalping sessions as an example, I am always being incredibly versatile when plotting my trend line. It's never really a simple trend line being plotted, because as price continues to progress, as price continues to change and vary in its dynamics, you often have to adjust your trend line. So in this instance here, when price came up, it broke through, so we wouldn't have entered yet. However, if you drag this even a little bit higher, you could have seen here price also broke through, then retested and then dropped lower. However, I probably wouldn't have taken this opportunity because it would have been a bit risky. So all I would have done in this particular instance is, judging from the messiness over here, gone back to the wick to wick, and this would have then been a more ideal situation. Very choppy, would have been a high risk trade, but it probably would have paid off massively, as you can see, once I plot the risk to reward tool. So as we can see, we saw the drive through, broke through. That's a good confirmation because the trend line's been drawn correctly. We come back down, we break through, incredible amount of mess. We then spike up, we then reject, we then dump. Now, upon seeing this sort of reversal, and upon seeing, especially if you go to the 1 hour time frame, from a 1 hour time frame perspective, this would have become a bit clearer. Now, if we quickly drew that back over there from wick to wick on the 1 hour, what you will notice is when you do go back to the 30-minute time frame over here, now that it's been plotted correctly, all you would be doing is looking for either the retest upon the closure of this candle around here to get the maximum probability trade. So it's very important as well sometimes when you are plotting trend lines, depending on the strategy you're going for. If you are going for, let's just say, a much longer term swing trade, you want to be looking at the daily, which again is very difficult in these current market conditions because they're never normally respected. And then you want to be looking for entries around the 4-hour time frame. So it's very simple stuff. If you're on the daily and you want to go for a very, very large swing, it's going to be hard to find some examples over here, but I will try and find any if I can. This could potentially be considered one upon that wick to wick over there, or even wick to body in this particular instance. Let's just say we were looking for an example like this, maybe using a Fibonacci in line with all of this as well. We can see, remember, you never want to enter with just the trendline retest. This has to be used in combination with everything else. So you can understand the overall trend, you can understand Fibonacci's, you can understand the overall dynamics of the market to give you the best probabilities possible. Now this would have been a beautiful trade. And the reason being is because the confluences were strong, it's on a daily time frame, which means the probabilities of this happening, considering the significance of the higher time frame price action, normally means you have a much higher probability. So even from a daily time frame, realistically, you could have probably set an order around, again, almost X marks the spot. This is something I tell the innovation community all the time. When you see trend lines crossing over with other potential variables like a support level or a resistance level or a zone, what I mean when X marks the spot is where you see the trend line crossover with the Fibonacci tool often creates one of the highest probability setups you can find. So when I say X, it's because the crossover is here. Again, if you had a, let's just say a trend line over here as well from these two wicks over here, that is essentially where X marks the spot as well. So you're combining a support trend line with, of course, the breakout trend line. So as we can see, the breakout, again, if you entered upon a breakout, especially on a daily time frame with stops below here, you would have just been annihilated. And also remembering that from a daily perspective, of course, the candles are much larger. The movements may be exactly the same in retrospect, but realistically, a movement like this on the 30-minute is not going to be as significant as a daily time frame move, which can sometimes span thousands of dollars on BTC. So what you want to be doing is waiting for that breakout. You've got a nice confirmation, price drives higher. You then go from the low to the high. Remember, this is not necessarily the low. This is the low after the pullback and the move higher. That's now the swing low, because this was basically a bullish candle, a bit of consolidation and a boom. But this movement is a swing low because it followed a movement higher and then it swung lower to then go back up. So upon seeing the breakout and the pullback, we then have a trend line over here, which I can mark in white just to show the difference. You then have the counter trend being broken and retested exactly where X marks the spot, alongside touching the 78.6 fib, which of course, using the prior Fibonacci lesson, then presents us an opportunity to take a trade, which would have obviously been a swing trade in this particular instance, below the wicks over here. Riding this up to the Fibonacci target alone would have presented a 4% opportunity. If you were to hold this the whole way through, again using other additional analysis, that would have been around 8.8% profit, with 1% risk, of course. So it's very important to understand that different time frames provide different setups and different time frames to actually hold these particular trades. Now, if we scrap this off, if we are looking more at shorter time frames, we want to be looking more at the 1 hour time frame and then using the 30-minute or the 15-minute to potentially enter. Now, you can actually mirror this on a 5-minute or a 1-minute as well. However, it does provide a much larger risk. So when it comes to daily timeframes and using the 4-hour timeframes, you have to remember that the stop losses will be much larger, which often means you may need a much larger account as well. Also, factoring in spreads, it can be relatively difficult, and that is why, depending on which platform or broker you're using, it can sometimes be a very costly experience when losing cryptocurrency trades. Holding trades overnight when it comes to daily time frame trades, ideally they need to be going in your favor, because then otherwise, if you are losing a trade, you are not only losing a 0.5 or 1% risk depending on what your risk is, you then have to take into consideration the commissions, the fees, or holding swaps overnight, which on most brokers, depending on your account size, can sometimes be £50 to £100 a single day. depending again on how much you're trading. So it's all relevant to consider. If a trade was to go against you as an example, and let's just say you bought over here, let's just imagine this was a daily time frame for a second and it took several days or even a few weeks, and you got stopped out here, you then would have potentially accumulated and racked up several £100 in fees as well, where your 1% loss would then potentially become even a 5% loss once fees are included, which is why it's always better when it comes to crypto, unless the market is really presenting some great opportunities, which we have seen here and there. Very rarely at the moment though, however, it's better to try and focus on shorter term trades where you can quickly bring that stop loss to break even and let the trade do what it needs to do. Because when it comes to crypto swing trades, you never really want to be putting your stop loss to break even too quickly, because very often the market will then come all the way back up as an example, or all the way back down, trigger you out in a loss, just say, or at break even, then continue in your overall direction. So a good example will be here. Let's just say you entered around here and you were riding a really big move up, which obviously would have been massively profitable. If you put your stop loss to break even straight away upon the first move higher, price will then likely come back, stop you out, and then continue on its merry way, which can be a bit of a double-edged sword when it comes to crypto trading. But more importantly, we want to be focusing more on the 1 hour time frame, the 30-minute and the 15. So let's have a little look and see what we can potentially find in these current market conditions. Now, going over here, I believe we already covered this one. If I'm correct, did we already cover this one? I think we did. Now, if we just drag this a bit lower, going over to the 1 hour over here, I think we covered this. If not, this is a very good setup regardless, because this combines a lot of stuff as well by the looks of it. If we haven't just covered this one, I think we got the wick, cutting through the bodies. Remember, you can go over here to the bodies, but then you wouldn't really know which one is the real breakout candle. So if we went all the way from here, first of all, it probably would have been from wick to wick over here. We've got the rejections. This looks great. It comes in, it retests, it pushes a bit lower. Now, when this breaks lower, here is a very good example of being versatile. Now, when this breaks lower, you obviously have to be at your chart when this is happening, unless you're always going from wick to body. Now, the reason I often go from wick to body is because you are allowing the manipulation to potentially benefit you as a better entry. Whereas if you did go for the traditional methods of using the wick to wick, you still would have had a rather valid setup. You probably still would have made good money if you didn't get stopped out, but you wouldn't be factoring in the potential moves lower. So let's just say we were working upon this specific trend line at the time of trading. Let's just make this blue very quickly. Once you see this drive lower, all you have to quickly do is move this down during the moment just to see if it correlates more with the wick to body. Now, if you can see over here, the wick to body is holding, that's perfect. You had 1, 2, 3, 4, 5, 6, 7 hours to enter a trade. So that means even on the final retest, which you can see was the most precise of them all, you could have then got the most optimal entry possible, unless you entered from here, of course. Stop loss just below, ridden the wave all the way up, and that would have been almost a 5% trade. Again, another example of why you never want to hold trades for too long. If you were holding this for the golden goose home run trade, it's very likely you're going to get stopped out and the market will then continue all the way in your favor. So it's very good to understand when you see big movements like this in the market, if it takes you into 2%, 3%, 4%, obviously if you are at the computer at the time as well or on your phone monitoring, it's very easy and simple to just get out of the market, take your profit and await the next opportunity. Because as we've seen in the likes of even the Forex market as of recent, it's not the most ideal conditions for swing trades, which means we have to do the best to our ability to capitalize off what the market is providing us. So this would have been a great setup for me, not just because even realistically, I probably would have entered around here on the retest. It's always good as well when it comes to these opportunities to remember we do not use buy limits or sell limits when trading trendline retest. We always want to be doing market executions, because when you're using market executions, you can actually leverage potential manipulation to enter live on the spot as it pushes through your potential level. However, if you were to even enter manually the minute it touches this trend line with a stop loss just below, and then you rode the first real drive up, you've still almost made 2% profit just by entering manually. Safe stop loss. Again, you could put it very, very tight, but realistically you probably would have been stopped out depending on how you put it. This would have been a great fortunate situation. That's also confirmation usually that price is now manipulated all the buyers who had tight stop losses. Then it continues off in a much larger direction. But what else can we use to potentially justify taking this trade in combination with everything else I've taught you guys so far in the prior lessons? Well, the first thing to note, if we get the horizontal ray, we have a shoulder, left shoulder, we have the head, the false move, we then have the right shoulder. Now, as we can see, price never broke below with the candle bodies through the left shoulder level. So this was a pretty much textbook setup. If we plot a fib from high to low as well, we can actually see we would have been able to potentially even capture the 78.6 retracement entry, because now we have a valid reason to identify where that wick fishing and manipulation was potentially going. Although we could have even entered here upon the 61.8, which is still a very good entry regardless, if we waited for that 78.6, knowing it was exactly there in line with the other candle bodies, all we could then do is a tighter stop loss just below this level. We now have a Fibonacci target in play, which is how you know pretty much exactly where to take profit. Now, as you can see, because we hit the 78.6, the likelihood of the minus 61.8 coming through increases massively, which means we can either take profit at the first hurdle around 3.9% or wait for the first level. Now, obviously it didn't precisely touch, but obviously as well at the same time, it would have either triggered through if you waited. Very frequently when the market does break through the minus 27% extension, it will hold it as support and then go to the next level. So you can often tell what price may be doing next by how it reacts to the Fibonacci extensions. And in this particular instance, I'm sure many people would have just taken profit before it reached. If it didn't, you would have still managed to have been triggered. But regardless, that would have been a 5.2% trade, even using only the 1 hour time frame. If we did go over to the 15-minute as well, regardless of the 30-minute even, it's still pretty much exactly the same. And essentially, there's almost a mini head and shoulders forming here as well, with the shoulder, the head, and the shoulder predominantly made by using just the wicks alone. So there are numerous ways to look at this strategy, but the most important thing to realize is the whole world tells you buy upon the breakout, because that's the confirmation, whether it's this candle or whether it's this candle or whether it's this candle. If you go to the 1 hour, most people would probably enter upon the larger breakout candle over here, not necessarily this one. Even if you entered here, you may have just got lucky, maybe just about got stopped out, or maybe just about saved, but it's not worth the risk. We want to be looking for the most optimal entries, because the market makers know, again, all markets are manipulated and controlled. They know very well that they tell you to buy the retest. So what they will be doing is they will now know, especially with insider information and any other kind of software and algorithms they're using, and order books even, especially brokers, they will know that a lot of people have now witnessed a breakout of the trend line, especially if you're going from wick to wick over here. So many people may have used this as an entry. So what they'll be doing is they'll be placing stop losses, either below the prior wicks or just a little bit lower, but regardless, they would have been stopped out. So the market makers understand when these formations are being presented on the charts, they know the majority of people are taking them, anticipating something like this, which of course is a horrific risk to reward anyway. Even if you use the Fibonacci from here, the signs still tell you. This is why it's very important to use other stuff. If you even waited for the retest of A, B over here, you would have seen the 61.8 was not met yet. So you can actually use the Fibonacci's as additional guidance to know where the potential trendline retest may be. Now, if I had this all set up here and then it drove higher, you'd be versatile. You move your Fibonacci from low to high. Now you can see, okay, we've broken through. There is a little trend line forming here. We have a 61.8 and a 78.6 lingering in this region. The average person would have entered here. So the market makers know stop losses will be in abundance around these regions. They give them a little bit of a push higher, a little sign of false hope that they have absolutely got a perfect trade. Price then drives in, wipes them out, and then they enter, gains the liquidity, price then rockets. So we know at this point in time, let's just get the replay tool out around this particular region here, now that we're seeing the drop. So we now know that there's a 78.6 fib here and a 61.8. So we now know this trend line here is not going to work with these crucial levels down below. These retracement levels very frequently come through, as you would have seen in the prior Fibonacci lesson. So all we would be doing in this instance is dragging this the whole way down as much as we physically can to correlate with the wick to the bodies. You've also got a wick over there. So now we would be waiting for this particular moment. So we can either wait for the entry exactly here with a stop loss below the 78.6, because remember, the beauty of using smaller time frame Fibonacci's as well is the 78.6 and 61.8% retracement are very likely going to be close to each other. So if you're entering from the 61.8, you can use the 78.6 as guidance to where you will potentially put your stop loss. And in this instance, I probably would have put it just below, because if I did prematurely enter, knowing price could go a little bit lower, the stop loss would have to be below in case price did absolutely dump towards this particular region. So if we press play, bang. We now know, monitoring this level as it's coming through, we can either enter exactly as it's coming through at this level, or the minute it touches, we enter. The patient trader, for me personally, I always like to stick, where possible, to the 78.6, because often, or more often than not, when the 78.6 is actually fulfilled or met, you're going to see a much larger move. And if it correlates with everything else you see in the markets, you have a massively high probability trade on your hands. So let me go back a little bit before this candle comes through. So now let's just say we were monitoring the markets at this particular point in time. So bang, we see it potentially coming through now. So I would be here with even my phone out with the order ready to market execute and an approximate stop loss. You have to be dynamic as well. This is one of the strategies I utilize quite a lot when it comes to scalping as well. I would now be waiting anywhere around this region. I would have my stop loss approximately ready. I would have my position size ready, and I would have my finger on the buy button ready, because the minute I see this trend line get touched, if I was going for the first entry, I would enter at that very moment. However, using the approximate guidance of a 78.6, there's two examples. You can wait for this to play out. You can see this coming in. I'd be like, okay, I'm getting ready. Bang. I would enter straight away. Stop loss below. Now you leave it to do what it needs to do. Now, you would have waited, hit the 78.6. Price is now holding the 61.8. Despite the fact it has obviously pierced through, we are still within this region. Then you hold the trade, then bang. In this very moment, you obviously see a bearish signal like that in the 1 hour time frame. Because it's hit this level, I probably, to be honest with you, if I was in this very moment, I probably would have closed the majority of the trade out here. But if you are patient, knowing that the 78.6 has been hit, you can then potentially hold this up to this particular level. As it gets closer, just manually close out as well. And it's very important when taking these trades to ideally actually be at your charts and manually exit the positions as well, because in crypto anything can happen in a split second. But the beauty is here with the 78.6. Now if you were, and if you really wanted to and you were busy, if you quickly saw this setup, you knew this may be coming through, you could easily enter. But the problem is, if you did set a buy limit at this fib, it's not always guaranteed, because the general rule of thumb is when price takes longer to fulfill the trend line is obviously sloping lower and lower and lower. So what that means is, whilst you may think the 78.6 fib is held, this is why I do the live scalping sessions live. I cannot give them immediately to the group. They have to be taken together. And that is because if we just set an order here, if price took longer to come through, this movement can end up coming all the way back down, potentially to where the prior wick is, or even lower, wiping out the movement over here, taking out the low, and then reversing. If we go over to this side now, and plot this from there to there, I believe it is, or was it from wick to wick? Yes, it was wick to wick over here. So if we again followed the same general rule of thumb, there was two potential trading opportunities coming into play here as well. So we can get rid of this. We've seen the Fibonacci's been fulfilled as well. Often, if you're lucky, you can get some great setups once the Fibonacci sequence has been fulfilled. If it's hit the 78.6 and you know price is going to potentially come up to this area, you can actually start getting prepared to take another short position, either as a hedge or just closing this position and entering a short. Now let's just say we saw this target is up here. Now we know if price can come back up after breaking through and retesting, upon this drive higher, we could potentially catch a retest on the trend line over here with a stop loss around where this high is. Because of course, Once this has been fulfilled, it's very likely going to pull back down. So all we would either do is put it very tight over here or just a little bit above to try and catch this to come the whole way back down. Now that we've got this over here, the first retest over here as well, you could potentially enter upon this retest. And the reason I've actually done it this way, again, if you draw the trend line out this way, it has worked, it's broken through, but you would have been tricked potentially entering short here. Whereas if you drag this higher, often it actually works better doing it this way, from wick to body almost, because it would have almost hit there. But in this instance, if you were to do that, it probably wouldn't have worked out too well for you. However, if you plot this from wick, cutting through to the wicks, to see where all the correspondence is, again, it's a case-by-case basis, you could then potentially wait for something to come through here, finger on the sell button, double rejection, it's rejected again, bang. So I probably would have entered this, just as an example, as it's now approximating around this level as well. That would have been a beautiful opportunity where you would have had around 3 hours to actually get into this trade. But of course, if you do now drag this a little bit higher, over to the wick to body, it still would have fallen just short, so you probably would have missed this opportunity. But even if you went all the way over here, as you can see, in this particular instance, first reversal would have stopped you out, you would have been tricked. So you have to use other factors as guidance to justify taking a potential trade. Now, because we knew this was going to potentially come through, again, just fell short, but that still would have been a pretty good entry for me. Stop loss, as we go over here to the wick, you would be placing this around the wick to wick. The minute this comes through again, whether you entered here or whether you entered at around this region just below, just to be safe, there probably would have been a pretty good trade on our hands. Now, if we leave this to play out, would this have worked quite nicely? I hope it does, because this would have been a setup I would have probably taken myself. So if we speed it up a little bit, so that there would have been around 1% instantly, then it would have kept going lower and lower and lower. Almost stopped out, to be fair. So that would have been almost 2%, letting this ride. And this is a good example of doing the replay tool, because it kind of shows you what the market would be doing. Now, realistically for me, despite the fact this may probably go a lot lower, I've forgotten what happened, I probably would have gotten out. One way to potentially do things as well, around the 2% mark. Again, this is a good example of how if you set stop loss to break even as well, price may come the whole way back down, take you out first, pinpoint at that exact level, and then it wouldn't surprise me now if it does actually come down. Let me just mark this out here. But then what we would be doing by pressing pause is getting rid of all of this for 1 split second, getting rid of this, getting rid of this, and getting rid of this. If we then go to the Fibonacci tool over here, we can see 61.8 has been met. So we then instantly have a profit taking target on this particular trade as well, which would have netted you around 2% or so. So it's all about being versatile. Again, remember, this is the 1 hour time frame, so it would have actually taken much longer to unfold. But whilst this is all happening, as you can see in perfect entry, if you put stop loss to break even, you would have been taken out straight away, and then it would have gone into profit. And then if you held even longer, it would have been stopped out again at break even. So it's important to realize when taking a trade, especially once you've calculated the risk, whether that's 1%, whether that's 2%, whatever that percentage may be, it's important to understand you've taken that risk, accept it, let the trade do what it needs to do, whether it's a win or loss. After that, you're fine. But if you just continuously move stop loss to break even, it shows you're not confident in your trades, and you've probably actually risked a bit too much money, because otherwise you wouldn't actually care what the trade is doing. The goal is to just either watch the trade if you can handle the emotional turmoil that comes with watching trades, or just simply take a step back, keep monitoring it every now and then, watch out for these particular levels, and then from there you can continue moving. When it comes to taking some potential profits, if you are busy, all you would be doing is using prior support and resistance, and also using the Fibonacci's as guidance. You could have put a TP just above this level in case it doesn't hit. Same as we saw with the extension on the short over here. Sometimes it's best to actually put it a little bit lower in case it falls short of either of these levels. But that would have been a beautiful consecutive trade back and forth. Let's just say you held it as a hedge as well. That could have been one way to do it. Let's say you entered on the fib. This drove the whole way up. You took profit there. That could have been around 4.5%, followed by almost an instantaneous 2.5%. So that would have been a beautiful trade to actually capitalize from. But let's go back, let's get rid of this and just find a few more examples. But hopefully now this is all making perfect sense to you guys. So let's have a little look here. This may not have come through, this one. Yes, it would have. That actually would have been a beautiful trade, and that would have even worked from wick, from body to wick. That technically is a wick over there, but you see what I mean. So if you did go in this instance, this would have been a great trade actually. I'm very angry I didn't take this myself now. Exactly the same. If this is the same one we were looking at earlier as well, I don't remember. They all seem to be doing the exact same thing. There seems to be a lot of repetition on these particular trades. You've got the head and shoulders, shoulder, head, shoulder. You've got the trend line breakout. You've got the false move. You've got the first retest. Now remember, we wouldn't have entered this because there were Fibonacci's down below. Now in this instance here, it would have fallen just short, unfortunately, of the 78.6, but this is where manual execution comes into play, or more importantly, putting this a little bit lower down to the body. Now in this instance here, this would have been a phenomenal trade actually, because again, shoulder, head, shoulder. You've got the 78.6 and the 61.8. All we do is manually enter the minute it strikes this trend line. I would have hoped it would have hit there, but when it strikes down, it can also be very tempting, by the way, to impulse buy if it falls short. One of the most important things I've learned from many years of trial and error and experience is when it doesn't hit, do not enter until it actually hits. In this instance, you still would have been okay, but by simply waiting for that exact level, the head and shoulders, the trend line retest and the Fibonacci's to come through, you would have yet again had another massively high probability trade. In fact, you would have had a 4% trade on the cards there, which if you held, which we probably wouldn't have, again, saying in retrospect, it's very easy to do, but you could have very easily, if held, gone all the way up to almost 15% again. So it is a case-by-case basis, but there are many different opportunities among these pairs that continuously seem to do the same thing over and over again. Now, I don't know if this one would have also been one. It would have been, actually. That would have been another good trade. So again, this is a textbook example because the bearish candle was a significant breakout bearish candle. Now, the majority of people, market makers, going short, stop loss just above the high, maybe even a bit higher, probably still would have got stopped out depending on how wide your stop was. In fact, you would have been stopped out regardless because it would have gone there and absolutely wiped you out. However, they enter here. So as you can imagine, all of the stop losses are located within this region from people that have gone short. So the best way to show this visually is if I get a horizontal line, I will make this a dotted line to almost represent a trading platform. Let's make this green and let's just make it a little bit thicker for now to represent a potential entry. So as you know, on most brokers like MT4, upon seeing the breakout candle here, people would enter. Their stop loss would then go above. Stop loss being red, their stop loss would be there. So this would be their entry. They wait for the breakout and their TP would probably be down here, which even I probably would have done if I was going short here. This probably wouldn't have been the greatest trade, but there was a bit of money to be made because if you go from high to low, it didn't actually hit the fib either. Probably hit the 50% on this one by the looks of it. Yep, that would have been a 50% trade. So you probably would have got stopped out on this one regardless. But if you were wise enough to take profits, it would have been okay. But it's a good example regardless. So let's say the TP color is blue. You are looking for a short from this particular level, stop loss below. You've entered upon the breakout. So market makers know there will be stop losses all the way over here from all of the people who are entering in these positions. There could be stop losses anywhere around these levels. So the majority of people entering here, all of the SLs will be around these regions where the prior wicks are, expecting price not to really go that much higher. Now, the market makers see a beautiful opportunity here to drive price down. It gives you hope that you are going to go into profit. So you see your trade go into a bit of profit over here. And then you think, okay, I'm going to hold this. So you hold it, waiting for it to go lower. It drives all the way down, comes back up, takes you out, retest the trend line, and then it goes into profit. Now you know, in line with this potential region here, once these stop losses have all been taken out, it provides the liquidity needed to drive price temporarily lower. Now from a 1 hour perspective, this still would have been a pretty good trade in my opinion, because once these people have been taken out, you can then enter at the absolute high. Knowing these people have been stopped out, you can enter on the retest here. Now your stop loss can definitely go even near that high, or you can push it even lower because you've caught a very optimal entry. Then you would just be looking to ride this down. Now this actually could have been a very profitable trade depending on your stop loss. And as I said, the general rule of thumb is around 2% at least. So even to make 2%, your stop loss would have been above that high. So actually that would have been a very good intraday trade to take. It would have taken a few hours to come through from the 1 hour time frame, but my goodness, if you had a much tighter stop loss, that could have even been 4% plus on this particular setup. So I probably wouldn't have actually minded taking that potential trade. But let us continue on our journey. We'll find one more example. Again, this one would have been more riskier as well because there wasn't really a Fibonacci in play. Even if you plot this down from wick to wick, it would have broken the Fibonacci as well. So that would have been quite a risky one to take. But if you were quick on your feet, that may have potentially worked out for you. So let's go over to here. There may be another one coming through here. Technically it would have, but would I have taken that? Absolutely not. This would have been a good one. This is one of the rare instances where it does actually kind of work, but no, technically it didn't actually come through. I wouldn't have counted that. Again, easy to say in retrospect. You may have got this one, which would have been phenomenal, but knowing the general rule of thumb, I would have been quite scared taking this one, unless there was an additional factor to help me with this movement. But again, didn't even hit the fib. That would have been massively risky for me. So I'm going to be completely honest and say I wouldn't have taken that opportunity because in the moment, it would have been a completely different circumstance. Now let's go over and see what else the market can bring us. In rare instances like this, these are often the easy ones, but this is what I wish BTC was doing more of during the trending markets. Now all we've done here is, because we don't want to cut through this, you obviously can do a little bit, which may have just about given you, it wouldn't have been too accurate, because whether you go from wick to wick over here, you then obviously would have caught this one through the bodies. Huge wick fish would have been a bit risky, probably wouldn't have taken that either. But once you've seen this one, this would have been a bit more ideal. There, that would have been a great setup because we have yet again the Fibonacci. Almost precise 78.6, but we wouldn't have had to worry about that too much. Trendline retest, break. Again, anyone that entered there would have just been annihilated in a matter of seconds. Wait for the pullback, ignore the Fibonacci's as long as you know they're there. That's an additional confluence. You wait for it to come through, taps the trend line, stop loss below the low over here, ride it up towards this target. And again, I probably would have taken profit there. That would have been at least 3 to 3.5%. If you were to hold the continuation, then guess what? That would end up becoming a rather whopping trade. Now, after seeing that movement there, realistically, would you have known to have taken profit at that particular point in time? Probably not. But if you saw this drop all the way down, you probably would have panic sold. You still would have made around 5.5 to 6%. So I really recommend going out there, experimenting on different charts, having a look at different things and seeing what you can identify yourself. There is an abundance of opportunities in this market. It can be much more difficult in the current market conditions, the way price is going, especially from these perspectives here. You know, BTC, if we were to go to $70,000 as an example, what we could potentially do is look at a setup like this, where price is now rejecting this level. We can then plot a Fibonacci from high to low. We can see the 78.6 fib is there, or we can go all the way down to here and wait for price to potentially come through to this wick over here, the very first wick. If this was to come the whole way down, hit this potential level, there's a nice trade opportunity on the cards. But remember, much wider stop losses are needed because it's the daily time frame. So what you could potentially be doing instead is looking more around this region where the breakout candle is confirmed. Whereas if you entered here, the breakout candle kind of consolidated and broke out. So either way is kind of fine. But if you were to enter over here, you can see if this was to slam down now straight away and come into this level around this particular region, once you go to the 4-hour time frame, you can even refine this even further by doing this instead. You can add 2 trend lines as well. This is something I often do to catch the manipulation. So if I make this a different color, this is the final thing I will show you guys. I'll make this green just to differentiate from the Fibonacci levels as well. You've got the main trend line from the daily over here that you've plotted. Whether it was this way or whether it was that way. Either way is fine. As long as you catch that retest and your stop loss is below the low, there's a good potential setup. Now, once you go on the 4 hour, remember daily to 4 hour, 1 hour down to 30 and 15 minutes. When you see this come through, you've got the additional trend line on the 4 hour now, where if I was to remove this trend line that we've just drawn, you can see quite clearly now, and no matter how you draw this, you can even push it a bit lower, but ideally around that particular level, you can see one, let's just fix that a little bit to make it more precise. We can see 1, 2, 3. It broke through, it retested. However, in this instance, it obviously absolutely rocketed. I wouldn't have taken that. That would have been incredibly risky. As you've seen before on the prior examples I've shown, they do not always come through. So often it's best not to take these ones because the breakout wasn't strong enough. There are times where no matter what you do as well, it's very important to understand whether if you've been in the markets long enough and you've been doing this for a long time, your strategy may be very, very precise, but no matter how good your strategy is, it will never work 100% of the time. No strategy will ever work 100% of the time. It's down to you in particular to realize this. If you continuously stick to the same strategy, and again, if this fits your kind of trading style, by all means definitely incorporate this in. But it's important to note it will not work every single time. But if you continuously use the same setups with 1% risk, they are going to work more than they are not going to work. If you want to take more of these additional risky ones, you are increasing the possibility of these not working. However, in the instance here, where we've got the Fibonacci as well, combined with this, and even here, potentially, just kind of preempting what BTC may do next by working in advance, we actually could just plot this over here, shoulder, head. Price could easily come all the way back down, take out the 78.6, come in here, tap this level around where the trendline retest is. Again, because it's so far away and because we're working from higher time frames, it may not do it. It could easily just come down to this level instead with this particular Fibonacci and instead come through, tap this level and fly. So it doesn't always work, and sometimes it can just, especially in these markets, as I said, where it's going parabolic, it can very easily just come all the way back down, test the trend line, fill the shorter term movements, because the 4 hour is still relatively significant. As you can see, we saw the breakout and the retest. All you would be doing is waiting for around this level. Obviously, we'd want to wait for ideally the 78.6, stop loss below, and looking to potentially ride a much larger swing trade up towards the $68,700 region. However, again, this wouldn't personally fit my risk preferences, my risk threshold. This is a rather risky trade to do. I would much rather wait for the more significant trend line over here, which hasn't really been retested yet. And although this may potentially work, you're leaving it more down to a 50-50% chance. Whereas when you're using other factors, although we can just leave that there for now, if you're using other factors like more significant price action to your advantage, you can see a confirmed breakout and retest already. All that means is, as we usually see, the second or third push, price has instead just absolutely rocketed this time. So if people were to enter here, it's very likely it may get stopped out. But there is no harm in taking both. You could just do 0.5% risk on this one and then do an actual 1% risk on this one. Stop loss below, nice and safe, even below there if you're going for a larger trade. And then combining all of the other factors that may come into play on this particular swing trade, you know, if you were to enter here, and this is also, again, I was meant to stop, but I've just found another potential setup for you guys as well as an example. Now let's just say you were to enter immediately off that 78.6 fib. By combining the trend lines, by combining the head and shoulders that's now potentially forming, price can easily come in, strike this level, enter you in, nice tight stop loss, triggers in, maybe spikes a bit lower, maybe leave it there, and then it comes back up and closes on the 4 hour above the 78.6. That's how you normally can catch additional manipulative moves. Shoulder, head, potential shoulder, trendline retest. It could spike here, close back above. Next thing you know, it fulfills the overall movement. You've caught a trade that can give you 10% return on investment. Now remember, from a swing trade perspective, it may even be safer to bring it down here. That is still 7% potentially on the cards right there. So it's all down to how you really want to play the market. But if you play it in a particular manner, if you combine this with the Fibonacci support and resistance, practice, I assure you, this will revolutionize your trading tenfold. This is one of my favorite strategies that has worked for me continuously and continuously again. And I have no doubt with the correct patience, the correct back testing, you will all find success in this strategy. So I hope you guys have enjoyed this particular video. I know this one's been long overdue as well. So many different things that can spring off from these potential subjects as well. I'm already looking forward to the next lesson, guys. So I will see you all in the next lesson, and I hope you've enjoyed this video.